Ladies and gentlemen, this is Carlisle Speaks Wall Street, and the question of the day is, when will the crash begin? Is tomorrow going to be the crash of GameStop? So, the price on GameStop went from, I don't know, $60 a few days ago, peaked out at about roughly $380 today. If you'd invested about $8,000 a few days ago, you'd be sitting on $32,000 worth of value. If you sold, well, not now, you wouldn't. But if you sold at the peak today at $380 per share, you'd have had $32,000 in your account. Not a bad deal, turning $8,000 into $32,000 in just a few days. However, the question is, what is next? Few considerations. GameStop was one of the most heavily shorted stocks, and obviously that's for a reason. Company has not been doing very well. They are mostly based in the brick and mortar realm, and obviously the pandemic did not help that too well. So they have been, to put it very crudely, sort of, well, showing my age perhaps, sort of a blockbuster video of video games, in the sense that Blockbuster Video is no longer a major chain that's everywhere, but back in the day it was. Wow, what a difference, Blockbuster Video. Yeah, so that is no more. So I guess sort of a legacy business. And again, not doing very well, so the future was not looking very bright, especially after the pandemic. This and many other reasons, looking at the fundamentals, a lot of investors thought that this is a good stock to short. So they short a lot of the shares of GameStop, the idea being that the price is going to come down, and obviously short selling, you're selling shares of a stock you don't own. So the idea is you sell the stock for current market value, you pocket that money, wait for the price to go down, then you buy it at a discount and you profit from the difference. So in general, what was happening maybe on Friday or Thursday or so, you had a lot of these investors sitting on these positions where they owed a certain amount of shares of GameStop, and they're just sitting around waiting for it to tank. And you get these Reddit guys who are basically creating a short squeeze by buying and encouraging others to buy a lot of GameStop. So that creates some momentum trading. So the more people buy, the more the price goes up. The more the price goes up, the more people buy. It's a snowball effect. And that whole dynamic is what led to what we saw on Friday, Monday, Tuesday, and then the grand finale, perhaps, today. Today, that surge from, what did we open at today? What is this? Was is das? Let's pull up GME. Where is your search? So, what happened today? I'm not in a good display here, but let's just say that it opened around 231 and it peaked at about 380, somewhere about, and that's just for today. If we go back to yesterday, we see, one second, that's Wednesday and Tuesday. So we see closed yesterday about 132. So 145 or so, opens the next day significantly higher. Um, this is basically amounting to millions and millions, and for some, even billions of dollars of losses, because they owe shares of this stock to lenders via their short sale. And now the cost to buy back those shares is through the roof, Alice. So not only are they going to lose all the money that they got from the short sale, they're also going to owe a ton of money, and that's a bad situation. But the bottom line is, this price is probably well overinflated, shall we say? Because again, it's been inflated because of these dynamics. This is not a natural growth on the price there, and also by how it moved up so quickly. So very, very unnatural. So I would liken it to what we saw with Bitcoin, where you saw these massive surges that happened in a short period of time, and then the fall is just as sharp as that. So I have a couple concerns about tomorrow. First of all, one thing to consider is that although day traders, individual investors have a great impact or ability to impact the market now, because so many people are doing it because of the commission free nature of things. So it's opened it up to millions and millions of investors, and that adds up, right? But the kinds of volume that we saw today and this week in general, because you can see a lot more volume earlier in the week, leads me to suspect that we might have some institutional participation. I know on the surface, many people would like to think that this is just like the individual traders. It's the, you know, regular people against the big Wall Street. But don't discount that there might be a third party involved in this. Consider this for a moment. Number one, in the investment banking world, there is a lot of, well, obviously research is a big component of trading, right? And there's a lot of tools that we use for research. Bloomberg terminals are very commonly used, and you can get a lot of information about what's happening, just news in general, whether it's the market or just in general, like let's say the economy, COVID vaccines are coming out, things like that. There are also, one of the great functions of the Bloomberg terminals is the chat functionality. So you're actually able to communicate from firm to firm and send messages back and forth. So there's a lot of communication that happens in investment banking, and there's a lot of research that's done. And I can tell you that there's definitely going to be some really sophisticated traders that are actually in these Reddit forums, they're in these social media sites, and they're monitoring this stuff. So with that in mind, knowing that you've got these folks that are out there watching everything and they're in the forums, it's not like, Wall Street is all, big shot, whatever, and they don't know about what's happening in the meme world. Don't be so sure about that. So consider this scenario. So you have these individual traders, retail, they're Robinhood traders, whatever, right? And they see this stock that's highly shorted, and that's a great opportunity for them to do this short squeeze where they're just going to keep buying and buying and buying, pushing the price up. And by pushing the price up, you're squeezing these hedge funds out of their positions, because the higher the price goes, the more losses they're going to take. And this is just a domino effect. The price is just surging and surging and surging. How high is it going to go? There's no limit. So they're just like, we got to get out of this. They buy back these shares at a way higher price than they sold it for, taking huge losses. And then by them doing that, they're entering buy orders. Remember, sell short, you've sold shares of a stock you don't own. So all you're sitting on is cash in your bank account, and then you're paying interest on that loan. So literally, you just have cash. So if you want to get out, if this is scaring you, if you're being squeezed, you're seeing the prices going up, you're like, whoa, 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 I'm going to lose money. What you're going to do is you're going to take that cash and use that to buy back the shares so you can satisfy that loan, because you got to give the shares back to whoever you borrowed it from. But with this massive surge, you're also going to need to find additional money, because basically it's going to cost you a lot more money to buy back these shares than what you got from selling it. So the main factor to consider is the way to get out of the short is to buy. And if you're a big dog, you're a hedge fund, you got millions of shares that you sold short. Now, to get out of that, you need to do the reverse. You need to buy millions of shares, and you need to do it quickly. We have various, there's proprietary algorithms, and there's standard algorithms, like we have what we call TWAP and VWAP. So there's volume weighted average price, time weighted average price. So these are one of the many sort of strategies that we utilize to there's many benefits to it, but one of the things that is a concern in the investment banking world is you don't want to show your hand. You never want to, let's say I have 1 million shares of GameStop. I would never want to just go sell 1 million shares of GameStop. Now, technically, I may actually enter just that, but that's not what you see. There's a lot of destinations that I can utilize where, you guys or outside parties won't know exactly that I'm sitting on 1 million shares. So there's things like dark pools, for example, and there are other mechanisms and order types where even though you're sending 1 million shares, what will happen is that order can be broken up into pieces. If you're using an algorithm, for example, it can send out periodically throughout the day, 1,000 shares, 5,000 shares, or whatever it is, based on what the price is and whatever parameters that you set. Problem with that is you need to get out of this situation super fast, because the market is moving very, very fast. So I don't think you'd want to sit on an algorithm like that that's going to break up your order throughout the day, because it kind of defeats the purpose. I mean, on one hand, no one's going to know how many shares that you need to cover, but on the other hand, while you're sitting there playing games or whatever, the price is surging, right? And your losses are just mounting. So it's a really, really bad situation. So I'm not really sure what strategies some of these hedge funds utilize in terms of how they got out of their positions. But I would just assume at least that they would be forced to be a little bit more aggressive than they normally would, because of the time urgency. They need to move very quickly. So perhaps much larger orders than they would normally want to put out there. But the bottom line is the overall end result of all of these hedge funds trying to buy back these shares so they can cover their positions and give them back to whoever loaned them the shares, is more and aggressive levels of buying activity, and buying begets buying, right? So that activity causes the price to surge. So where does that leave us for tomorrow? And I guess, I'm sorry, I lost my train of thought there. So what I was getting at is when I talk about the third party. So this is retail guys, individual investors versus these hedge funds, right? Hedge funds are being squeezed. The retail guys are just, they're smelling the blood and like, yes, bring it up, buy, right? Price is going up, and they're watching their account values skyrocket to insane values. And on the other hand, people are running for cover in the hedge fund world. Now let's introduce a third party. Let's introduce a, shall we say, whale, a high net worth individual, or even just an investment banking firm that is not shorting the stock. So they're not involved in the shorting. They are an outside observer, and they're watching this happen. Because again, everyone's watching the news. Everyone is in the chats, and there's a lot of information sharing that happens internally at the investment banking firms. And also there's some information that obviously is accessible to the outside world. But the bottom line is, Wall Street would have known that this was taking place. So what happens to the people on the sidelines, on the institutional side? So you've got no interest in GameStop, right? You don't have any positions. You're not involved in any of this. But you are ever the opportunist, and you say, wow, this is really cool what these guys are doing on Reddit. All these individual guys are doing on Reddit. But they don't have the kind of money that we do. So let's give them a little nudge, right? Let's give them just a little nudge. So as the prices are surging, and you can do this algorithmically as well, and you probably want to do that to protect yourself, because the market can move very, very fast, high volatility. So you want to be able to respond really quickly. High frequency trading, perfect for this, right? So you have a sophisticated algorithm that can trade automatically and just super fast. Your market data is coming in super fast, so you're able to see the price movements before the rest of the market. You're able to receive those price updates super fast, fractions of a second, and you're able to have your system automatically respond to those price changes and send out orders and get those fills before the rest of the market is able to even see what's happening. Like they're seeing like the shadow, right? The echo, right? So you can be ahead of the market. So a sophisticated system can sit there and watch the price movements. And then when it's on its way up, you start buying and pushing it up and pushing it up and pushing it up. And then when it's dropping down, you may pause or whatever. And there's a lot of different things, people that are way smarter than myself can get into mathematical theory and probabilities and all this kind of nonsense. I say nonsense, but the folks who are the experts get paid very, very well for their expertise. And me talking about PhDs, so they know what they're doing. And if they, it's a big firm, you've got a lot of money, you can enter a lot of orders and add to this volume. And what you're doing is a domino effect, right? So all these individual guys are pushing this thing and they're moving the price up, and it's moving up aggressively. And then you got a big dog who, again, you're not going to step in with like huge orders. You're going to break it up, but you're adding to the volume. And you're adding the technology aspect to where your system can look at how the price is moving and can do a lot of things. You can actually even make and extract profit, as the day goes on, in terms of, you buy 100 shares so it dips very, very, for a short, let's say it dips for even 2 seconds. So the price dips by, I don't know, $2 in 2 seconds. And in those 2 seconds, your system is able to send out high-speed trading, send out 100,000 shares, GME, buy. Boom. Ticks back up 2 seconds later, another $2, right? So now you just bought 100,000 shares at a price $2 less than it is right now, because it just did a little dip and you were so fast that you were able to jump in at that dip, and then you sell at the $2 more, right? And with 100,000 shares, simply getting that $2 per share, um, that's some significant profits. So you can keep doing things like that, where you're pushing the price up, you're extracting value from it, by buying on the dips and being able to. And this is something a normal investor wouldn't be able to do. A retail guy is not going to be able to do, because you don't have access to a high speed trading system. You don't have access to real time market data that's moving that quickly, and a system that can move that quickly. You don't have the ability to set up these sophisticated algorithms. You don't have access to the PhD guy, right? So they can utilize that technology, that infrastructure, to sort of ride this wave and, in fact, further amplify this wave. So don't be sure that everything you saw today and this week in general is all just, Reddit traders. I wouldn't be surprised if there's some other big dogs that got involved in this as well. Frankly, that's what I would do. As an outsider, if I were a firm that wasn't invested in GameStop and seeing what's happening, I would definitely be seeing dollar signs in my eyes and like, whoa, how can we make some profits? I mean, that's the point of trading, right? You want to maximize your profits, and here the stock is moving very, very quickly. And again, you have the infrastructure and the sophistication to be able to extract a lot of profits very, very quickly by entering large orders very quickly, buy, sell, whatever, right? So some of that might be involved in this. So where does that lead us with tomorrow? So I feel like this stock is highly overvalued. So it's got to come back down. I mean, this is not a natural movement, but it's not that simple. It's very easy to just sit on the sidelines and say, the price is too high, it's going to come back down, it doesn't belong up there. But that perhaps is a very oversimplistic way of looking at it. Dylan K, is it in-store only? Did this? I believe, well, we're going to get to that. We're going to get to that, whether it's online or in-store only. Hedge funds use the new USB. My son was telling me, swooga. swooga. So tomorrow, in short, no pun intended, tomorrow, one of two things can happen. And it doesn't have to be tomorrow, but I would be watching this very, very closely between tomorrow and Friday. Either we have a repeat of today and it continues to rise ridiculously and it goes to $600 per share. And part of the reason is all of this attention, right? Remember we said momentum trading, right? Trading, buying begets buying, right? So when you have a bunch of people buying, other people see this buying activity and buy as well, because your buying activity is pushing the price up. So they buy as well. Their buying activity pushes the price up as well, and then so on and so forth and so on and so forth. Then this creates a lot of noise. So you see all over mainstream media, you have MSNBC, CNN, all these guys. Oh, Reddit, oh, people making money, right? So that can have an effect of further amplifying this momentum to where tomorrow we start and it's like 300, it's 400, it's 500, it's 600, which makes things even more scary, because the higher this thing goes, the scarier it gets, because we are very likely pushing this stock well away from where it should be. So the further away that we push the stock from where it should be, um, is the more pressure for a correction or a collapse. So that's the other alternative. Tomorrow, the market opens. Maybe it it opens at what's it at 252. Maybe it opens at 305, shoots up to 380 to 400 by mid morning, right? That's all that people trying to jump on board. They're like, whoa, 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 we want in, right? Because remember, the the momentum from today and the last few days are in the community, whether it's institutional or the retail guys, right? These are people who have a vested interest. They're looking at it. They're traders. They're in on this. But now we have a much larger audience. The audience has been amplified tremendously through the media. Now we have a whole bunch of other people like, whoa, maybe I should invest as well. So that pressure can lead to a morning surge. Maybe it goes again to 350, 380, 400. But by mid-morning, maybe we see it start dropping, 380, 350, 300, 250, 200, 150, right? And that could happen Friday. That could happen tomorrow, when this whole thing falls apart. However, and one thing you have to always consider when you're dealing with trading is no risk, no reward. The greatest reward comes from the greatest risk, right? So there's another thing that can happen. And this is getting to what you were talking about in the chat. The simplistic model of looking at GameStop as a failing company that has no future, that's why everyone was selling it short. You've got to look beyond that. That was then, this is now. Now, my understanding is they have new management. We have to also consider the value from the stock price going up this high, depending on how many shares that GameStop has. They can sell some of those shares to get cash. From that cash, they can use that to invest in the business. So let's go back to Monday when they were trading at $40 per share. A struggling company where things were not looking too bright. They have limited options because the ability to raise capital at that point would not be very good, very likely. Because, I mean, if your business is struggling, who's going to want to invest or lend you a lot of money knowing that you're possibly in a sinking ship? So they would perhaps not have a lot of access to capital. And as you know, business costs money, right? It costs money to start a business. It costs money to maintain a business. And it costs money to save a business. For reference, AMC, I believe it is, AMC, which is another stock that they're targeting. That company was potentially looking at bankruptcy as a result of the surging of the price that happened this week. What I'm getting from them is that they're saying that they might be good, at least for this year. I don't know what they did, but they made some kind of move to take advantage of the surge in the price. Now, again, there's always the option of liquidating some of your shares. I would presume that AMC is the largest shareholder of AMC stock. So, or regardless, they don't have to necessarily even be the largest. They certainly would have a lot of shares of their own stock. So the ability to, sell some of that share, sell some of the stock, and basically liquidating it and cashing out, and then using that money to pay off your debt and invest in whatever you need to, whether it's marketing. I mean, again, business runs on money. So you can use that money to save your business. AMC apparently is doing that. I would presume that GameStop can do that as well. So from this opportunity, they can use this to rectify or to save the company. Also, there's new ownership. Also, they're looking at transitioning to being more online than just being a brick and mortar. And that's a big part of the problem, this brick and mortar thing. That's a dying business. The pandemic didn't help. So with the influx of cash, they can supercharge their movement to online. And if they do it right, if this manager, this new CEO is good, and he invests his money right in terms of marketing and building up whatever they need to build up the website and whatever, this right here, this exciting moment for the retail guys with the prices surging or whatever, this can be exciting for GameStop as well in terms of their access to cash, right? Cash that they can use to save the business. So what does that mean? What that means is if you're thinking that, oh, the price is so high, it's got to come down like we talked about before. And that's a very good probability. Don't be so sure. Again, without risk, you have limited reward. You've got to take on the risk. So something like this, it is a lot of opportunity to make a lot of money. People make a ton of money today. You can make a ton of money tomorrow, Friday. In a short order, you can make a lot of money. So that means the way that the fundamentals work is that there must be massive levels of risk associated with it. Otherwise, you wouldn't have this great opportunity. That's just not how it doesn't work that way. You just cannot have massive amounts of potential reward without high level of risk. That's the way it works. Think about the most safe thing you can do in terms of investing. Savings account, right? You're insured. I think it's up to $250,000 FDIC. So your money's not going anywhere as long as you don't touch it and you have you keep your minimum balances or whatever. Your money's going in one direction, but not much reward. You're going up. What are you getting? Interest, 0.0002%. So you're not really getting a lot of returns, but from that, you have a high level of security. You don't have to worry about your savings account. You don't got to watch it. You just let it sit there, right? You have the most comfort, and that means the least amount of reward. This is a high reward scenario, so that means high risk. So don't be so sure this thing is going to crash. How do you know that GameStop is not going to average $300 per share or anywhere near that for the rest of the year? How do you know? What is going to stop this from hanging out where it's at right now? There's no guarantee this is going to crash, right? There's no guarantee. They turn around GameStop, so this happens, pushes it up, and you got these guys holding it, and they think it's going to go higher, whatever. And next thing you know, they start making changes in the company, and things start looking up, and the earnings reports are going up, and they're like, whoa, this is good. Then it's like, why would it go down? Because you're thinking they're starting a new business, things are going great, the vaccines are out, in general, the outlook is trending towards getting better over time. So if they're in a better state, who knows? This thing goes up to 350, 400, or whatever. So don't count on it crashing, but on the same token, be prepared for it to crash, potentially as soon as tomorrow or Friday. Now, I know people would like me to give them some magic answers and like, oh, this is I don't know. You can't know what's going to happen with this, right? There's so many factors, so many variables. And again, you also have these players that are involved that you don't know about, and you don't know what their intentions are, right? So there's even another factor where this can actually go south. So consider for a moment that the individual who's mainly been pushing this in the Reddit community, if you're pushing a stock to where it's rising aggressively, and it's a company that's not doing that well, there is the risk that it's going to crash and go down, like we just discussed. So, to avoid that risk and to capture or maintain those massive gains that you have, you would need to close your positions, right? You bought all these shares and you got other people to buy them, and that momentum, prices up, 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 right? Now, if you want to preserve your returns, you need to sell. So, imagine if that guy is a bad actor and he plans to keep telling everyone to keep buying this thing and hold it, hold it, hold it. Meanwhile, he accumulates a very, very large position. I mean, certainly not compared to what some of these hedge funds have, but, and then he, without notice, sells everything, protects his earnings or his returns on this. And by him doing that, him or her, if it's large enough, maybe that creates a momentum towards the bottom or for it to fall. Imagine if, you know, like I said, like I told you, there's definitely people from the investment banking world on the institutional side who are in these groups, in these forums. So imagine that the guy who's been pushing this is the whale himself, showing screenshots of some normal size positions, $500,000, $800,000 or whatever. I sold my house or whatever the story is, right? But imagine he's actually sitting on millions of shares of GameStop and plans to sell it all tomorrow or Friday without telling anyone. So all of a sudden you see these massive sell orders being generated. Because again, this guy he could actually work for an investment bank, right? Now, if that is the case, and the SEC finds out, oh man, he's gonna be in a world of hell for that, because that would be extremely fraudulent, for sure. I have my doubts about even what's being done. I don't know what the SEC has to say about it, because I would be concerned about whether it's considered market manipulation or not. But that depends on the details of how things were done. But regardless, whether it's legal or not, you could have a big player who's the one who has got all these people, all these little investors, day traders, you know, doing their little $10,000, $5,000, $50,000, whatever it is, and pushing the price up, surging it up, and this guy's sitting on massive amounts of shares of it and starts dumping them, and again creates a momentum in the opposite direction, and then a ton of people lose a lot of money. Now, one good note for that, if there is any good note to that scenario, if that ends up happening, is to the people who are involved in the group, they would have been the early adopters in terms of jumping on this bandwagon, shall we say. So they actually potentially have a lot of protection from that scenario. I do not think that the exchanges would let this stock just plummet from like $400 per share to $50 per share in like a few minutes or something like that. If we see a massive sell-off that is super aggressive and just moving out of control, we're probably going to see a halt. So that would give a lot of these guys, so the original guys, an opportunity, even if they get screwed by whoever the group leader is, that'll give them an opportunity to at least jump out before things get crazy. So let's say they ride it up to 400 and it starts plummeting and it gets all the way down to 200, but they jumped in at 60. So at 200, they're looking really good. They halt trading, and then all these guys just start putting in market sell orders. And then as soon as, because now they're alerted, because they see it falling, they're all aware, so everyone starts putting in their market sell orders. And then when they resume trading, it starts falling again super, super fast. And it keeps like all this panic selling, boom, 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 boom. So the main people who would really lose, I mean, what they would lose is a lot of their massive gains would be taken away, but they would still end up, most of them, perhaps profitable, because they could probably get out, because there's so much range, they could probably get out before it gets to the price that they paid for it. They just may lose a few $100s per share, which would not be good, but it's better than losing money, right? They would still be profitable. They just lose a lot of the profit. The people who have the most to lose are the people who watch the news today, the stragglers. You jumped in where it's already high. You don't have a lot of wiggle room. If something like that happens, you're probably not going to be able to catch it, especially as an individual trader. Sophisticated institutional guys, they got the systems. They can be out of there in a blink of an eye, less than even microseconds. But to any small, regular traders who buy in, market on open tomorrow orders or whatever, to me, they have the most to lose. It's mostly risky for them because, again, they don't have the access to that real-time trading system, the high-speed trading, where they can quickly respond to things. So by the time you see it tanking, it's already going to be way below what you paid for it. So we could see, if that happens, people who buy early in the morning or whatever, they're going to be the ones who are most at risk in terms of individuals, not the Wall Street folks. So those are my concerns. And like I said, there's no simple answer. I can't tell the future. No one can tell the future. I mean, for someone who's not in this community, who's holding GameStop or even these short sellers, how could they have known that this would have happened, right? This is something that's outside of reality to an extent. So a lot of things that can be that can't really be predicted can happen. But bottom line is, I would be watching this very, very closely for the next 2 days. Tomorrow could be a repeat of today, or it could be an absolute collapse. If you're going to jump in on this, obviously, as I always say, never invest more than you're willing to lose. And make sure that you take measures to protect yourself from losses if the price drops very quickly. Like, I actually jumped in at 168. I knew it was high risk. Like I said, no risk, no reward. I did a small position because I wanted to limit my exposure. And what I did is so volatile, it's moving very quickly. I protected myself from not being able to respond quickly enough by setting stop loss orders so that if the price dropped below a certain amount. So basically I set, what is the maximum risk that I'm willing to accept? How low of a price drop am I okay with? Like, this is I don't want to lose any more than this amount. So I figured out that amount. I set stop limit at that price point. And then I did my thing. I monitored it, buy one share, buy another share, whatever. And then, like clockwork, because it's highly volatile, it did move very quickly, and my stop limit orders triggered. So pretty much that got me out of it. So I took a small loss, like $30. I'm still up like 1,400. I'm let's say last 300 days or so. I started at the bottom, so the March crash. I anticipated that previous year, sitting on the sidelines, and jumped in really close to the bottom, and I've just been riding that wave up. I mean, my biggest positions are like 40% gains, 34% gains. Um, I mean, I made in the last couple of weeks, I think like $700 just on one of the positions that I had on Airbnb, and it was a very small position. I didn't have that much, but that's how much it gained since I purchased it. So um, make sure you do things like that where you have orders set up where if the price drops below a level you're comfortable with, it'll automatically sell. I mean, obviously that there's risks with that as well. If it's just a temporary dip and you set it too close to the current price, it can dip below that price and trigger your sell, and now you're out of the game. So let's say it's at $300 per share, and you set it at 250. It dips to 250 just for a few seconds. Your sell orders trigger, and then it shoots back up to 300 to 380, 390, and you're out. You're out. You sold everything, right? So make sure you give enough sort of range between what the current price is and what the limit is for, you know, what's the maximum loss you're willing to accept, and you know, utilize strategies like that so you can protect yourself, because this thing can move very, very quickly in a short period of time in both directions. It can surge tomorrow or it can collapse tomorrow. And I think you should hope for the best, but prepare for the worst. Prepare for this thing to collapse to $150 per share between today and tomorrow, or for it to go up to $500 per share or $450. Could go either way. But those are my thoughts. As far as what might I do, well, I think GameStop is a little bit too hot for my blood. So, hey, what's up, man? We'll keep. I can't even. I don't know how to pronounce your name. I think what I might consider is AMC, because GameStop has been surging for already a few days now. I mean, AMC as well, but GameStop, I believe, was the leader in this. So there is potentially much more room for the price to surge up. And it's also a cheaper stock, so you'll be able to buy more shares. So, for example, current price $14. Let's just call it $14 per share. So you can, let's see, $14 per share times 100. Let's see what's a good amount. Let's say 500. Okay, so let's say you are really crazy and your life is super boring and you are willing to risk $7,000 potentially being cut in half in one day. You started the day with $7,000 and you ended the day with half that. Supposing you are willing to risk that scenario. So you purchase 500 shares of AMC at $14 per share, the current price now. Let's say this thing surges and goes up to, let's say, 150. So you've invested $7,000, and in a few days, you now have $75,000. You turned $7,000 into $7,000, yeah, into $75,000 in a few days. If AMC goes from $14 to $150, for example, I don't see that as being very difficult to achieve. If we have a similar surge like we saw with GameStop. So that's the thing that interests me about AMC, the ability to purchase more shares. By purchasing more shares, your per share gain is multiplied, right? So if it goes up by $1, right, dollar per share, then multiply that dollar by 500, so that's $500, right? So whatever the dollar amount per share that increases, multiply that by the amount of shares, and that's how much money you can make from just a small gain. The problem, however, is with everyone knowing the game and institutional guys, being prepared for exactly what we're discussing, you invest $7,000 to get 500 shares, and then the price collapses. It was just at $4 not that long ago. The price collapses to $4. So now you invested $7,000, and in a few days or a day or an hour, you now have $2,000. You crunched your $7,000 in cash down to $2,000. Now, that is awesome compared to losing millions of dollars like these hedge funds. Because again, with when you're shorting stocks, the amount of losses is infinite, because basically it's based on how much the stock price goes up, and there's no cap on how high it can go. I mean, this could go up to $600, $1,000. I mean, it wouldn't happen, but there's nothing stopping it necessarily from going up that high. So I would much rather be the guy with the $7,000, which again, like I told you guys, don't invest more than you're willing to lose. So you didn't need that $7,000 to begin with. If you're smart, you didn't need the $7,000. Otherwise, you shouldn't be investing it. And then you took $7,000 and now it's $2,000. I mean, it sucks. And I would hope that it didn't take you 10 years to save that money, right? Because people have different savings rates. I mean, if it took you 10 years to raise that, to lose it in a few days, that would really suck. But compared to being in debt for tens of thousands of dollars or millions of dollars, I would rather cry myself to sleep after crushing my 10 years of savings down to $2,000 from $7,000. So just keep that in mind. It goes both ways. But like I said, that's why you protect yourself. You can choose to pick a price that you want to jump in at, pick a price that you want to jump out at, and while you're waiting for your target price, you have these orders already set up, these sell limits or stop limit orders, that if the price starts to tank really quickly, that you'll exit out of your positions. Do everything you need to do to protect yourself from things going south, and going south very quickly. You guys are not using dedicated trading platforms and things like that. I mean, your computer can crash on you. You can have memory issues, and the price is tanking, and you're trying to sell, and like your internet connection goes down. Right? On Wall Street, I mean, everything's like super secure. There's redundancies and backups. I mean, the infrastructure is insane, right? Of course, you have a dedicated support team on all different levels, network engineers. You have all of these resources. You guys are just home, sitting on your laptops and your computers, and you got to keep in mind that the stock can start moving rapidly against you, and you may not be able to respond either through technical issues with your computer or your internet connection, or just the kind of account that you have. You know, the latency between you entering your order and it actually, getting executed. What's the delta of the price change that can happen? So just keep that in mind. So I don't know. I don't know what I'm gonna do, but I don't think I'm gonna mess with GameStop. I would rather try to do something with AMC, but I'm not sure what. There's another stock I think that they're looking at doing. The guys on the forum are claiming that I don't know why Friday is special, but they're saying to at least hold until Friday. But I wouldn't trust that, because again, the main person pushing that, or persons, they can be playing you guys. So the whole thing is, in that scenario, the plan would be for them to exit before you exit, because by them exiting, if they have large enough positions, it's going to start the surge of prices going down. So ultimately, you want to be the first to sell, right? And if you're kind of running the show, everyone's listening to you, and you're like, buy, hold. You have the ability to control this dynamic to where you decide when you want to sell. And you're able to have the market be stable to a degree where all these people are just holding because you're telling them, and then you sell, and that causes more selling. But you're good. You got your profits and you're out. So you got to be aware of that. So this idea of like, oh, wait until Friday, and then what? He sells at the close tomorrow, midday tomorrow, or at any time in the day that it surges massively. There he's like, okay, I got my gains, I'm out, right? So just keep that in mind. So that's all I have. So I'll be watching AMC. I'm gonna think for some time before market open tomorrow about what I may want to do. I don't want to mess with my portfolio because it's doing so well right now. I want to be careful. But one of the things that I'm going to do is I'm going to mitigate my exposure levels by limiting the size of any positions I take on. So, if I take on a position that's only 5% of my portfolio, obviously with a normal buy market order, I'm limiting my exposure to 5%. Because if it completely collapses to zero, which isn't going to happen, then I've lost 5% value, right? So that's sort of putting a limit there. But if I invest 100% of my portfolio, then obviously I can lose everything, right? If it actually goes to zero, which again, I don't think it's going to happen. So that's all I have. I'll just check on the chat, see if there's any additional questions. Otherwise, buona notte. Click on the like. I got no likes. No likes. Let's get the likes up, guys. What's up, Dylan? Wikion. Eyeballs. Is it you? I guess it's because I haven't done a video in so long. All right, guys. Thanks for clicking on the like button. I really appreciate the support. Be very, very careful. Pay attention. Watch the news. Do a lot of research. Don't be emotional. Have a plan. Stick to the plan. Mitigate your risks. Diversify your portfolio. And just be careful, guys. Be careful. Tomorrow is going to be an interesting day for sure. This is Carlisle Speaks Wall Street. And on that note, buonanotte. Ciao. I need some outro music. Where's my outro music? Bum, 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 bum. Outro music. Bum, 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 bum. Ba-na-na-na. Here's my outro music. Okay, that's really annoying. Super annoying. Holy moly. How dare I ask for likes and then I blast that into your ears like that? Horrible. All right, guys. I'm out.